We are going to go over three primary types of equity swaps. So we have all three listed right here. So the first one is receive equity return and pay fixed. So in this example, we could say the person who is receiving the equity return, let's say they receive the S&P 500's return, and in exchange, they are paying someone else a fixed rate of, let's say, perhaps 7%. Now we can get a little bit more complicated and have another equity swap that is receive equity return, pay floating. So in this case, let's say the person who's, receiving the S&P 500 return is paying a floating rate that could be like LIBOR or SOFR plus, let's say, 3%. Now, that could be an example. Or we could have a receive equity return, pay another equity return. So in this case, the person receiving the S&P 500 return could be paying the opposite party in the swap, let's say the NASDAQ return. Now, there's another type of equity swap, which is actually a total return swap. And this one includes dividends paid on the underlying stock or index during the tenor of the swap. So basically in the return calculation for the swap, they're including dividends. Now these up here, these basic equity swaps, these are not based on dividends. These return calculations do not include the dividends within them. Now equity swaps are OTC contracts. And then we're listing 4 features of these equity swaps down here. These equity swaps are like forwards, essentially. So let's just break down what I mean. So OTC instruments are over the counter. They are not exchange traded. There is no exchange involved in this, which means that when there's no exchange, there is credit risk exposure. Because there's no exchange, that is basically decreasing the risk to both parties. They're now exposed to the other party's risk that if the other end of the swap owes them money, now they have to take it on credit that those people can basically pay them back at the end of this swap or at the payment date. So they are usually collateralized to help alleviate some of this credit risk. So you have to put up some collateral in the event that you couldn't pay, they can take your collateral from you. So this is like forwards, right? Forwards are OTC. They are not exchange traded. More illiquid. So like as opposed to an exchange traded derivative, like those you could just go and trade in the market. Whereas forwards, they're a handshake agreement essentially with 2 parties. They're more liquid. Typically no voting rights. So this has to do with the equity underlying the equity swap. The voting rights on the stock are not going to come with the swap, and then they're more customizable. So anything that's exchange traded usually has very standard features, like a corn future would be always on, let's say, 1,000 bushels of corn. You couldn't do it on 820, whereas if you go into the OTC area, the over-the-counter, you and your counterparty can agree to whatever terms that are best for the both of you.
You can get 15% off full CFA courses featuring my lecture videos by clicking the link in either the pinned comment or the description and using promo code Ryan15 at checkout.